some proper details, some analysis on what's driving commodity markets. Jonathan Barratt from Commodity Broking Services in Sydney is standing by. Jono, let's start with oil. Under pressure, is it really just all to do with fears about growth in the US, or is there more to it than that?
Kylie, look, it is interesting. There are concerns about growth, obviously, in the US, and if that starts to peter back, then there are concerns for demand. Still, those continuing concerns in Europe sort of weigh heavily on confidence. And also we're starting to hear concerns in China in the local government debt situation, and there's possibilities of defaulting there. All these issues are sort of coming to the head, and people are saying, well, look, if the confidence isn't there in the market, then why should oil prices continue to be higher? We did see last week that we had a build in inventories. If tonight we get a build in inventories, then I think we'll see oil prices lower. But at the end of the day, Kylie, that's actually a relief because we want primary input prices to be lower in order to help our alien economies.
And the price of copper, which is also weaker, I guess that's just an extension of the same story.
So it is similar, but there is a nice little twist to the copper story. Copper has risen probably about 10 to 15% on the back of strikes in Chile in the BHP Escondida mine, and that's losing about 15,000 tonnes so far. So if we do get a sort of a conclusion to those labour unrest there, then you find, I think, copper is perhaps shaping up for a much larger sell, or actually a much larger fall. Remember, it's just shy of that 10,000 mark in the LME complex and about that 450. So you can actually see, I think, copper actually coming back to 400, which once again I think is good relief for those economies looking to use copper.
Yeah, we'll be hoping to get a little bit more detail on what's likely to happen there when we hear from Rio Tinto later on this afternoon when they report results. Talk us through what you're watching with gold. This rally just seems to have no end in sight, certainly not running out of puff at the moment.
Oh, look, it is remarkable. There's no doubt about it. I had a good look at the technical side because I guess technically I think some of the market really focuses on it. That 1665 and 1670 had a high over 1670 last night. So I actually think that the trend line resistance up there will probably hold it for the time being. We are looking for a pullback or at least some consolidation after those moves we've had over the last week where we can get on again. One of the key motivators to that, I guess, is the supply side to the market, where we're continuing to see supply fall and demand pick up, and that surely only means that gold should go higher. But realistically, it's very hard to buy it around this 1670. In fact, I'd like to wait to see if we can get it a lot lower so I can get back on board again. At the moment, we're square, just looking to re-enter the market. If it breaks through that 1675, I think it'll force our hand and we'll have to tip in.
So do you believe that 1700 is achievable? A lot of talk around that's going to happen, and it's going to happen soon.
Look, this is the big thing. It's achievable if in fact we can't get what's required out of the economics, out of the market, out of the debt. The debt ceiling issue, that's out of the way. The market's now focusing there on some form of obviously the cuts in spending. Will that alleviate inflationary concerns? Probably will. So that might mean that 1700 might not get there this time round. You know, concerns in Spain, if that starts to pick up, then I think you'll find that people will start to refocus again. Obviously, those concerns we also mentioned in China. So whilst those geopolitical debt issues are alive, then I think there is this propensity for people to move away from equities, away from other investments, actually, and to spread some of their portfolio in gold. And I think 1700 is certainly there if, in fact, those debt issues in Spain and China continue to evolve.
Okay, you talked about cuts there in the US. Also, coming out of the US is talk about spending, more spending, to stimulate the economy, some form of QE3 perhaps. What does Ben Bernanke actually have available to him?
Well, I think you're reaching deep in the bottom of the tool bag for that one. Look, it is going to be quite interesting. What can they do? And QE1 and QE2 did actually work, and I think these are the questions which are overhanging the market. I personally feel that we're going to get a lot of persuasion, particularly out of journals, out of the Fed, saying that we will look to do something. They're not going to abandon the market. They've got to support the market, whether it's a QE3 or some other form of stimulus. I think will be the key. I think something will happen, but seeing that we haven't had the results in 1 and 2, then I've got to question whether or not QE3 will actually work. I actually feel that the better form is to use other measures to lower primary imports to stimulate jobs. And I think they're thinking through that at the moment. One such is to get that US dollar a little bit firmer through some reason. Remember, the long bond there still represents a very good buy. We just got to make sure that the economy is okay.
Yeah, okay, Jono, thank you.
Okay, take care.